Some homeowners are in for quite a shock in the not so distant future if rates stay higher for longer. If you own a home right now and you have a mortgage, specifically a fixed rate mortgage, you're going to want to watch this video. My name's Macallum and I'm a real estate agent and team leader in the city of Toronto. If you want to chat one-on-one about real estate, buying, selling, or leasing, all you have to do is click the first link in the description of the video and you can book a meeting directly into my calendar. And if you learn anything from this video or any of my other videos, please take 1 second to click both the like and subscribe buttons. If you own a home with a fixed rate mortgage, let me know how you're feeling in the comments section. I want to see if we can create a discussion and share thoughts and our ideas. It's no secret that over the past almost 2 years, rate increases have slowed down the red-hot real estate market. But who actually felt the pain of rate increases? Because it wasn't the 5-year fixed rate holders. It was, and actually still is, the variable rate holders. As what I'm hoping is going to be a super quick summary of the main types of mortgages, you can either choose a fixed rate, variable static rate, or a variable floating rate on an amortization schedule, which is usually 25 years, but is all dependent on the individual buyer. So if you're a fixed rate mortgage holder, it may be a 5-year fixed term, which is the most common, on a 25-year amortization schedule. And the amortization schedule is how many years it takes for the mortgage balance to get to zero. And the rate is not the same for 25 years. It's the same for the 5-year term. And when that 5-year term is up, you'll need to renew the mortgage at the current rates. And in the case of our current mortgage rate environment, the rate you may have received 3, 4, 5 years ago is likely a lot lower than what it is today, which means an increase in your monthly payments. And then there's the variable floating rate mortgage, which is easiest to explain and understand. Basically, your mortgage payment each month will fluctuate with the Bank of Canada's overnight lending rate. If the interest rate goes up, your monthly payment goes up. If the interest rate goes down, so does your monthly payment. And then there's the variable static rate mortgage, where your monthly payment does not change even if interest rates go up. That is until you hit the trigger rate, when your payment no longer covers the interest on your mortgage. But let's get back to the fixed rate mortgage product because that's what this video is all about. As you recall and know, fixed rate mortgages are only for their term, and at the end of the term, they renew at current rates. So if fixed and mortgage rates overall remain higher for longer, then we could see many homeowners who purchased real estate in, let's say, 2019 with a 5-year fixed mortgage at 2.5% needing to renew at 6.5%, which is a significant and instant jump in monthly mortgage payments. And if the homeowner was originally stretched financially to make the initial purchase and they haven't increased their income or saved additional capital, then they may be in a bind and potentially required to sell. That's what everyone thinks though, but we have what's called the stress test, which a lot of people were not in favor of. And it could actually save a lot of homeowners who have purchased with very low fixed rate mortgages because those buyers were stressed at a higher rate than they actually got. And speaking of saving potential buyers, there's also the possibility we see something similar to what happened with static variable rate mortgages over the past year. And that's extending amortization periods in order for the owner to keep their payments reasonable and also keep their home. The bank said to homeowners, hey, you want to stay in your home and you want a reasonable payment. Okay, we'll extend the amortization in order to make that happen, but you're going to have to pay us more interest over time. And this is what's been propping up the real estate market over the past year and a half because it's allowed homeowners to not become forced sellers. A lot of people thought that homeowners hitting their trigger rate was going to cause many to sell their properties and we'd see a massive flood of new listings. But this never really happened because of the extending of amortizations. But let's jump back again to the fixed rate mortgage issue, which could be a disaster in the future. In Q3 of 2023, major banks detailed their mortgage loan percentages, and it's pretty alarming if you ask me. TD reports 12% of their active mortgage loans are up for renewal within 1 year. Scotia has 19%, CIBC has 25%, and BMO has 15% renewing within 1 year. And all of these borrowers bought when rates were significantly lower and will need to renew at a higher rate, which has some people frothing at the mouth, waiting for a massive amount of inventory before they strike. But what if that doesn't happen? What if the bank says to the borrowers, hey, we know you bought a home at 2.5% 5 years ago, and your amortization went from 25 to 20 years. Would you like to extend it back to 25 years in order to make your payments more reasonable? And if that does happen, I'm pretty confident most homeowners would be ecstatic to hear that they could have a lower payment in comparison to what they thought they were going to get, and they can still keep their home. At the end of the day, this scenario is good for the buyer in the short term, but not so much in the long term because they're paying the bank more money through interest. And the bank wins because they don't have to take possession of the property and put it under power of sale, and they get more interest payments over a longer period of time. All of this is to say, are we in for a massive shock to the real estate market over the next 2 years? Let me know in the comments below.